be interesting to talk a bit about the company from a financial discipline standpoint.
Of course, we're a company with a very stable business model based on highly predictable revenues and resilient margins. First, predictability stems from the fact that our contracts are always long-term. These very long tenors provide a high level of certainty on the revenue side and foster strong relationship with our anchor clients in each country. In addition, our business model is delivering solid organic growth. Second, the resilience of our margins. The most relevant is that our contracts are linked to CPI, which provides a strong protection. In addition, we are immune to energy volatility, as this is a cost that impacts our customers to a greater extent. I would also like to highlight that we operate with a fixed cost base that is largely covered. Consolidation in the mobile operator sector, far from having a negative impact on our revenues and margins, has a positive dynamic effect on the industry. Larger and stronger groups will be better positioned to undertake the significant investment still required across the European continent, and this will boost our future growth.
Let's now turn to one of the priorities of Cellnex's financial policy, capital discipline.
Absolutely. Our capital allocation committee is guiding our investment and financing decisions. A set of golden rules and financial criteria has been established to optimize growth and returns, and to actively review our investment, debt, and shareholder remuneration policies. The objective is to balance strategic investment with financial strength and investor returns for sure. In addition, we are engaged in a deleveraging process that has allowed us to reduce leverage by almost 2 turns since 2022, with a firm commitment to set a long-term leverage target of 5 to 6 times net debt to EBITDA by 2026.
Investment-grade commitment is also part of capital discipline, isn't it?
Sure, to ensure consistent access to the debt capital markets and lower credit spreads in future refinancings. Cellnex expanded and refinanced its main syndicate credit facility, increasing from 2.5 billion euros to 2.8 billion and extending its maturity. The company financial strength is reflected in its investment-grade ratings. S&P Global Rating affirmed the BBB- rating with a positive outlook, while Fitch Ratings maintained the same rating with a stable outlook.
We seem to be on the right track, which I assume is always good news for shareholders.
As a result of our strong financial and operational performance, we will be able to deliver on our commitments to increasing shareholder returns. We already executed 1 billion euros share buyback in 2025 and communicated an attractive shareholder remuneration plan for 2026, including the start of a 500 million dividend this year and up to 300 million in share buybacks. In the last 2 years, we will have remunerated our shareholders with up to 1.8 billion euros, representing almost an accumulated 9% yield in 2 years.
A very good point, Raimon. Thank you so much for the conversation.